Morning, everybody. Welcome to our new series of webinars, New Term, New Skills. Throughout this season, we will be giving you the basics of different sectors of specialist finance, empowering you to identify the opportunities with your clients, discuss the options available, and feel more confident to move forward. We're almost exactly a year on from the turmoil caused by last September's mini budget, and one sector hit very hard by this was buy-to-let. What was once seen as a prime tool for investment and income generation for your clients has quickly become a challenge, and many customers have had to change their plans. In today's session, I'm joined by two expert panelists who will talk us through some of these recent changes, answer some of your questions, and shine a light on the opportunities still available to brokers and borrowers alike, as well as share some tips on how to get more of your applications accepted. Hopefully, at the end of this, you'll leave with a better understanding of the specialist buy-to-let space from multiple perspectives, how to avoid some of the pitfalls, and again, keep some of your applications moving. So whether you're a seasoned broker or whether you're just looking to learn new skills, let's go for an inside look at specialist buy-to-let. For those of you that have joined us before, you'll be familiar with the Q&A buttons at the bottom of the screen. But for those of you who are new to us, please take advantage of these buttons. We'll be taking live questions throughout the session, and we'll do our best to cover off as many of these as we can. We also have some handouts and documents available, so please keep an eye out for these as we move through. Right, after all that, let's meet today's panel. So today I'm delighted to be joined by Charlie Stack, Key Account Manager from the Mortgage Lender, and Cara Williams, Intermediary Relationship Manager from Together. Good morning, both.
Good morning.
Good morning.
Right, so obviously I know you both very well. Let's give you the opportunity to talk to the brokers available. So Charlie, do you want to start us off? A quick elevator pitch introduction and background for yourself?
Yep, so cheers, Chris. I'm Charlie Stack. I'm the Key Account Manager for TML for the North region. I've been at TML for 7 years now. I started off as a BDM and then got promoted to Key Account Manager in February last year. So what I do now is I look after specialist firms from packages, including Crystal, to your specialist buy-to-let firms, the biggest buy-to-let firms in the North as well. So hopefully I'll be able to answer most of your questions today. Any concerns you've got, any criteria questions, anything you need to know about the market, hopefully I'll be able to get those answers over to you.
Thank you. Cara?
Hi, everyone. Happy Tuesday. I'm Cara Williams, Intermediary Relationship Manager at Together. I also cover the North region as well, and packages likewise as Crystal. I've been at Together 9 years. I've come across all sorts of, we'll call it quirky and wonderful scenarios. And I'm looking forward to speaking to you all today and answering your questions on everything about buy-to-lets.
Thank you. And for those of you that don't know me, I'm Kris Corns. I'm the Operations Director here at Crystal. I've been here now 16 years, I believe. Started off as a BDM and worked my way through different roles within the business. So again, you've got a huge wealth of experience on today's session. So if you do have any questions that come up, any specific cases, anything that your clients are asking you, please feel free to fire those over to us. And I'm sure we'll do our best to answer them. Anything we can't cover off, we'll pick up with you after the session ends. Excellent. So Charlie, we'll start off with you. Obviously, we've all seen the turmoil over the last 12 months or so in buy-to-let. How would you summarize some of the bigger changes from the lender side of things?
I think the biggest change we've probably seen from a lender's perspective over the last, as you say, it literally is 12 months now, has been the interest rate increase. That has been the main driving factor of the buy-to-let market, the increase in rates. That's caused, as you say, the turmoil that you mentioned. Lenders have almost had to adapt in this environment, whether that's by increasing their rates because their cost of funding's increased, but then what we've had to do almost is on the flip side, increase completion fees so that we can reduce the initial rate to allow that level of borrowing if it can be met. Few things that we've done sort of our end is if we have had to increase our initial rate, the completion fees have increased. So we have got, different fee structures ranging from a set fee to a 2% fee, 3% fee, 5% fee. The whole point of those higher percentage completion fees is to benefit that initial rate to allow you to achieve the ICR coverage. Another thing that I think a lot of lenders are starting to adapt with is, what we do at TML anyway, is allowing the completion fee to be added above and beyond the maximum LTV and ICR. So it might look a scary fee of a 3, 4, 5% fee, but you are able to add that on so you can still achieve that loan size. So again, the turmoil has predominantly been that rise in interest rates.
Thank you. Cara, how about from Together side?
Yeah, absolutely. I would agree with Charlie as well in respect to the rise in interest rates. And it's scary to think into this. This started 12 months ago now, and sort of how many rate increases from several different lenders over the last 12 months. I think as well, we've actually seen a dip in applications for non-professional landlords over this period. We do at Together allow first-time buyers and first-time landlords and even top slicing to cover the rental shortfall. However, we have seen a decrease and a decreased uptake in this, principally due to affordability and sort of the stress testing. We have actually seen landlords diversify into other buy-to-let assets. So for example, your HMOs, your multi-unit freehold block conversions, and some movement also into holiday lets due to the increased rental returns available. And we've also at Together, we've seen an increased purchases in limited company names rather than individuals. So I think it's landlords looking at different opportunities rather than just your non-professional landlord, for example, looking at different opportunities of how they can get the best rental yield with the increased rate and also the higher stress testing.
Apologies, there's a fire alarm test going on in the background. I'll mute myself in a second. We do get a lot of questions about stress testing on there as well. So with the margin already being applied to what is a high interest rate and then a stress rate applied to that. Anything to comment on that, Cara? We'll stick with you.
Yeah, absolutely. I think stress testing, particularly in the current climate at the moment, with cost of living, with rates rising, nobody's got a crystal ball what's going to happen over the next 12 months, unfortunately. But I think it's essential for all parties. In the market, there are increased arrears in the buy-to-let sector, and stress testing allows all parties, including lender and applicant, to enter into the transaction with their eyes open. I think at Together we can mitigate this with stress testing with top slicing, and top slicing is utilised for the right clients. It isn't for everybody, but it can be an option for the lower yielding properties and portfolios as well.
That's interesting. I'll come back to that in a second. Thank you. Charlie?
Yeah, I think lenders and brokers, we've got to be quite innovative. The PRA changes that came into play end of 2017, that they're coming out of their 5-year benefit period now, or have been. So what we're seeing a lot of, which we don't actually do at TML, but is incorporations. So they're incorporating from personal name into limited company, utilising Section 162 for tax relief. It is different ways of working. So the biggest bit of advice I could give, which I hear this off some of my specialist buy-to-let firms, is build those relationships with tax specialists, build them with solicitors, build them with valuers, because they're the people that are going to be able to assist you in placing more cases, in particular tax advisors and accountants, etc. Going back to the stress testing, the standard norm now seems to be for limited company 125 at pay rate. So again, I know I mentioned it on the first question, but looking at those higher percentage fees, you are going to get a lower initial rate, meaning the stress test is going to allow you to borrow that little bit more. The other thing I'd highlight is if a client's coming to you, a landlord's coming to you with one property, if the ICR doesn't fit on that property, it gives you an opportunity to look at the rest of the portfolio. Look at the remainder of the portfolio. There might be 2 or 3 other properties within that portfolio that have got equity in. So it links back to, what we spoke about at the start. How maybe can you get more completions? If you're looking at a portfolio, you might be able to get 4 deals out of 1, but it's still the right customer outcome.
There's an interesting word you used in there as well with that innovation, and something you touched on a little bit earlier was the higher fee, lower rate. I know that's something that you guys do at TML. How's that going down with the borrowers? So
our 2 most popular products are the 5% completion fee and then the fixed fee of 2495. The fixed fee of 2495 flies through because if the ICR isn't an issue, it's a set fee. It's nice and easy. Maximum loan on that's up to £500,000 as well. as I say, that 5% completion fee does allow you to achieve the loan size that you're looking for. Another lender's introduced another product last week where it is a higher completion fee than what we've got, but they've actually done a post about it where it actually illustrates the benefit of utilising that product on a certain loan size, and it breaks it down if you're on this fee, or their new product that they've launched, and the difference in loan size is about £40,000. So again, don't be afraid or scared of these high percentage fees, because if it is a 5% fee across a 5-year fixed, you're loading 1% onto the loan each year, 1% onto the rent. It isn't actually as scary as it seems.
Interesting solution to that, because it means that stress calculation on day one, it might fit for that particular product, especially where it's a remortgage or something if you're coming off a rate elsewhere.
Exactly.
So yeah, we're seeing a bit of interest in those products at the moment, which is quite nice. And Cara, one thing that Together offer, as you touched on, was top slicing for the innovation. So if the rent doesn't quite service where it needs to, you can look at background income from the client. How are you seeing that going down?
Absolutely. So we're having good levels at the moment on the top slicing, and the good thing about Together is we have no minimum income criteria. I think in respect of, we're seeing it being utilised more on your portfolio landlords, whereas your non-professional landlords, your first-time buyers, your first-time landlords, it's probably a stretch on the affordability at the moment, which we've probably seen the most declines in. What I would say at present, the top slicing with the right client, the right property, and probably more on the lower rental yields is something to utilise with your clients and to have a look at, to get to, for different investment opportunities.
Thank you. That leads us into a pre-question that we've had in. Sorry.
I was just going to say, we don't do top slicing, but it is something we're going to launch into.
We've had a pre-question in from Naz. So landlords previously had a business model of purchasing a property, waiting for that property to increase in value, remortgaging that property to release some capital to then go on and buy another one. Now, obviously, more and more more and more borrowers are struggling with that business model now, because the rental yields won't allow that capital raise. Are you seeing any change in borrower type or borrower appetite as a result, Cara?
Yeah, absolutely. So I think the most capital raising that we're seeing, particularly from portfolio landlords, is in respect of buy-to-let second charges. So we're seeing a lot of buy-to-let second charges at the moment, and these are being used to improve EPCs or purchase new properties. What we're also seeing is buy-to-let second charges to raise extra on the deposit. So when they're looking to purchase a new buy-to-let security, they've already got buy-to-lets in the background, they're looking at adding a buy-to-let second charge to help raise that deposit to add to their portfolio. So I think it's like what Charlie mentioned before. It's buy-to-let portfolio landlords looking at different opportunities and ways of being able to increase their investments and to increase their rental income as well. And another type of purchase transaction we are seeing at the moment is the use of short-term bridging to buy assets quickly and then exit onto the term product. As you rightly say, we need to understand, and the landlords need to understand, the rental they will earn to make sure it covers the exit and the stress test of the exit at the back end. And as with any bridge, the key is the exit. So the key is the buy-to-let exit at the end. So it's just looking out for and making sure that landlord and yourselves are looking at the whole, at the application as a whole. We are also seeing signs of rationalised rents increasing, but I couldn't comment on sort of any sort of particular areas across the country on that.
Thank you. Charlie?
I think what you can do is you can take the bridge out with Cara, and then we can be your exit route. Day one remortgage, nice and easy. But yeah, no, I'd mirror what Cara says. I think landlords I think your casual landlord is starting to, maybe, if they only have one or two properties, what we are seeing is the hassle and the finance that it costs, maybe they are selling up. professional. I do think the industry or the market itself is going to turn a lot more professionalised. I think your professional landlords are seeing huge opportunities still in the UK housing market, whereas, as I say, those part-time landlords who do only own a couple are selling up, but it's a perfect opportunity for a professional to expand their portfolio. One thing I just touched on was day one remortgage. I think that is another thing we're seeing a lot of. So a professional landlord is going to auction, buying a property for cash, or whether they are taking out a bridging loan with Together. And then we are able to assist with those cases, whether they've bought it for cash or whether it's a bridge. Day one remortgage, get the money back out, and they're able to go and do it again. Again, increasing the amount of deals that you're able to get, increasing the amount of completions you're getting, and they're still building their portfolio.
Yeah, sorry, just to jump on the back of that as well, Charlie, I think you're absolutely right. I think the portfolio landlord, and you touched on it earlier, you said innovation. I think it's looking at different ways of how they can look at investment properties. So whether that be your day one remortgage, we do those at Together as well as your bridge. Whether that look at your day one remortgage, or whether look at different types of investment securities that, you know, your HMOs, renting out 4 separate bedrooms on 4 separate ASTs will again increase your investment. Looking at multi-unit freehold blocks, or even what we're seeing a lot of at the moment as well is social housing. So buy-to-lets being rented out to asylum seekers, vulnerable adults, vulnerable children. And here at Together, we don't shy away from any of that. We will look at all different types of tenants in a buy-to-let security.
I think the different type of landlord is an interesting topic as well, because if go back 12, 24 months, people were buying buy-to-lets as a long-term investment, but it was also generating a monthly income as well, the surplus from the rent that you were receiving against the mortgage payment. I think a lot of that perspective of the market has probably dried up now, where the bigger proportion of that rent, if not all of it, is now going to service those mortgage payments. So it certainly changed that income source for a lot of landlords that might have been relying on that previously. And I think something you touched on, Cara, as well, was that you're seeing fewer purchases from first-time landlords. You seem to back that up.
Yeah, absolutely we are. We monitor all sort of our applications and completions, and something that we're really looking at the moment is buy-to-lets and sort of what products we can help support you guys in the market, whether that, like Charlie mentioned, you know, your higher fees, reducing those rates, reducing, you know, looking at that stress test. And we have noticed a dip in your first-time buyers and your first-time landlords. So I think sort of your more professional landlords and your portfolio landlords is something that's probably going to be a big focus area, particularly over maybe the next 6 to 12 months.
Interesting, thank you. So Charlie, we've had a question in from Fiona. She's seeing a lot of decline cases due to the difference between the actual rent being received and the rent coming through from the valuers on the reports. Obviously, we know surveyors work from comparable data, and with the slowdown in sales and lettings, that comparable data may be lagging behind the current picture that we're seeing on the coalface. Are you seeing anything along those lines, and how can brokers mitigate against that?
So the Connells did release a report stating that they are seeing a larger increase in decline cases. That is naturally because surveyors are that little bit more cautious at the moment. I think everyone would agree with that. Fiona's exactly right. So there is probably a lag in the completions. We've got to wait for those completions to come through before we start seeing almost the benefit. There is a lag. We need time for it to catch up before we start seeing almost the fruits of our labour of those completions completing, allowing the rentals, allowing the valuations to increase. It is one of those things at the moment. I think the main thing is just manage expectations with your landlord. That'd be my biggest bit of advice. Explain the market to them at the moment, which hopefully they are understanding if they are a portfolio landlord. Biggest bit of advice is just manage expectations and wait. You know, I did see that rentals, BBC did release something last night, it was on the news, saying that rents are up 12%, which of course is fantastic for a landlord, obviously not so much for the tenant, of course. But there are some positive signs that we are starting to see. Biggest thing I would say is, you know, valuations not quite stacking up is a huge issue. Rates are starting to come down, as we mentioned earlier. Are rates going to come back down to 3%? Like if we had a This time last year, believe it or not, we had a 3.33% product with no fees at all. Are they going to come back down to that anytime soon? No. And that's the big thing I just try and say to the landlords is this is at the moment the new norm, and just manage their expectations.
Thank you. Cara?
Yeah, absolutely. I do think at the moment it is about managing your landlord's expectations and just sort of educating them on what is going on in the market at the moment, because, you know, like was mentioned on the news yesterday, it was the 12% rental increase. And I think more and more people are looking to rent because, you know, first time buyers are finding it hard to purchase their first residential home. This is a really interesting one because I get this coming across my desk more and more and more at the moment. So all I would say is don't panic, because we as a lender, we are seeing increased rentals compared to what's coming out on the valuation. I think, as previously mentioned, valuers are being a little bit more cautious at the moment, and, you know, and hopefully that will sort of change over the time. You know, I'll look in my inbox every day. You get the NACFB emails, you get the bridging and commercial emails, and every day there is a lender with a new rate coming down. You know, a swap rates come down, 2 years, 5-year fixed rates start coming down as well. One thing we are doing it together at the moment, if there is a difference in between the valuation and the rent, if yourself as the broker can find us some comparables in that area that is close to the rent that your client is achieving, we will look at the actual rental, not what the value is stated. So we are having to look as a lender at how we can adapt our criteria to how the market is adapting as well.
Thank you. We've had a question just come through live on there. There is a lot of pressure on landlords at the moment with upcoming EPC legislations, the new no-fault eviction laws soon to be passed. The question is, how can the panel help to ease these worries for landlords through support, criteria, etc.? I'll stick with you, Cara.
Yeah, absolutely. And I think with this, I think it's creeping up, EPC in particular, isn't it? Ever so fast. It's scary to think that it's Christmas, and, you know, I don't want to say that word, but it's Christmas in sort of 3 months' time. I went into my local garden centre 2 weeks ago to buy some garden furniture, and the garden furniture sale was gone, and they were building a Christmas display. So I was like, oh wow, it's really, really creeping up. And I think EPCs, etc., will creep up even faster before we know it. I think the key at the moment is education. I think it's at the key relationships, so key relationships between client, broker, and lender, and just keeping that communication flowing. Lenders to keep the communication flowing in sort of what criteria changes and how they're supporting in EPCs. Brokers educating clients on sort of deadlines, what the legislation is, what EPCs is all about, and how lenders, clients, and brokers can support each other before those changes creep up, and before we know it, before they're here. So I think the key at the moment is education and relationships to all help each other.
Julian?
Yeah, I'd echo exactly what Cara said. The only thing I'd just like to mention is I think lenders have got to almost adapt as well. A lot of lenders have already brought out, you know, green products, whether that's rewarding a client for home improvements, whether it's by changing the boiler, changing the windows, etc. And I think there needs to be a bit more innovation around those products. We haven't got one at the moment, but similar to top slicing, we are launching it probably before the end of the year because we need to. Obviously, it's not officially signed off just yet. The EPC changes, the guidelines and deadlines do seem to change every time we have a look. But that would be the main thing I'd highlight is keeping communication with your lender. Speak to your local BDMs at whatever lender it is. Speak to your client. Keep reassuring them of the changes. But yeah, just be in touch with your BDMs, your key account managers, whoever it might be, about a certain lender's criteria. If they're bringing out any new products, if it's a green product, what's it going to be? And yeah, just keep in touch with them.
Yeah, that's a couple of points that we'll just dive into a little bit more there. Firstly, the EPC is obviously something that will come in at some point. Exactly when remains to be seen. And I think that's a really good opportunity for people to look at additional borrowing options, because there are a number of lenders currently offering green mortgages. And the big benefit for borrowers for that is the lower interest rate. So where we are struggling to get that serviceability, we can use these lower rate products in order to make that fit. Obviously, there's an expectation there that the property meets a certain EPC rating. To get to that point, again, there's bridging options, there's second charge options. As Charlie touched on, you can look at remortgaging the wider portfolio to release some capital from there. So I think if you're working with your buy-to-let clients, it's certainly worth a review, looking at what they've currently got. If they come to you for one buy-to-let, look at the wider portfolio and how can we get these into that A to C rating quicker in order to benefit from some of these lower interest rate innovations that are going through from that point of view. Just had another question coming live. I think it's one specifically for you, Charlie, from TML. From Andy, thank you for your question. Why do TML insist on advice on unregulated loans?
You'd have to ask someone a bit more senior than myself for that one, unfortunately.
That leads me nicely onto one of the other topics that I've got noted down here, consumer duty. There's a lot of changes that are taking place in the industry. Just when we've had a tough 12 months and rates have gone through the roof, stress testing's changed, we then get consumer duty thrown on top as well. But one of the questions there is about this foreseeable harm, isn't it? It's not enough anymore just to treat your customer fairly. You have to prevent foreseeable harm or reduce foreseeable harm moving forward. So I think the advice piece ties into this non-professional, maybe first-time landlord that we were looking at. If someone's looking to top slice, they're a first-time landlord, the income might be very, very tight in there. What happens if the tenant misses a mortgage payment, a rental payment? The pressure that's going to put on that landlord suddenly is huge, and we're automatically putting them into a negative position to start with. So I think there's a responsibility not just on the lender to educate, but also on the broker. That when we're talking to our borrowers, we need to talk them through, well, what would you do if? Where's the surplus income that's going to support this? How can we protect this loan as we move forward, the same way we do with protection on a standard mortgage? Yeah. Anything to add to that?
I think you covered most of it there, Chris.
Brilliant, thank you. So a nice question that's come from Andrew pre-registration. I'll give you a nicer one this time, Charlie. That's how we could get more completions. So what are the main causes of declines that you're seeing that we can try and do something about?
Do you want me to go first? Yeah.
Yeah.
So similar to what I said earlier, if you want to grow and write more completions, it is about diversifying a landlord's portfolio, looking at different avenues. As you just reiterated, then looking at the whole portfolio. If they are coming to you with that one deal, what else can you do to help them? Touching in on the EPC, every question we spoke about so far almost all links into the same one. It's about you trying to get the best outcome for your landlord, for your client. If they've got a portfolio of 10 properties, 2 of them are EPC ratings of Ds, you know that when this legislation comes into play, they need to improve that EPC rating. They're not the 2 deals that they're coming to you with. They're coming to you with the like-for-like remo that just needs remortgaging. You've actually got 3 deals there that you can look at, in which case there might be an opportunity then for further investment because they're releasing equity out of 3. They're improving the EPC rating on 2 of them by changing the boiler, the windows, etc. And they're left with surplus cash to maybe go out and buy another one at auction to grow their portfolio. I think that is the biggest thing, is diversifying the portfolio. Cara mentioned it earlier, looking at HMOs, MUBs, something we've seen well, not myself personally, but I spoke to the account manager who's down in London yesterday, and she said she's seeing maybe a professional landlord in London selling one property and diversifying elsewhere, selling one property and being able to go and buy 3 or 4 up north. The yields may be stronger, the yields may not be. It's about looking at different options and avenues that your landlord might be able to look to go down.
That's where we're seeing success from some of the more prominent buy-to-let brokers, if you like, that they aren't just order taking as such because it's a non-regulated space and we can go through it. It's that full service that's been offered. It's reviewing the portfolio. What are the future plans? What do you want to get out of this? Where do you want to be in 10 years, 15 years? And then building the model around that. And that's where we're seeing some real big wins at the moment. Cara?
Yeah, I would agree with everything that you've both just said there. It's about kind of looking at the wider picture. I think declines are frustrating for everybody, aren't they? We as a lender don't want them. You guys as brokers don't want them. Your client doesn't want them. And after a review at the moment, the declines for us personally together is affordability. So it's about looking at different opportunities and diversifying the client's portfolio, whether that be looking at HMO, whether that look at being a multi-unit freehold block, whether that looking at I think we're quite lucky in the north, aren't we? Ours is some places in the north are a little bit cheaper than down south. Whether that looking at, like Charlie said, selling a property down south and buying 3 or 4 rental properties to add to the portfolio in the north. It's about looking at the wider picture now and different opportunities for your landlords of how they can still keep on the buy-to-let ladder, but also increase their rental yield as well.
Excellent. Thank you. So are you seeing, let me rephrase that. What tips would you give a broker to give their application the best chance of going through?
I would say gone were the days where you could close your eyes, keep your fingers crossed, submit the application, and it goes through. I'd say you've got to look now at your application at a whole. Look at the loan to value, look at the affordability, look at the security and the client profile as well. You've got the application has to be strong in order it to sort of fly through without either a decline, for example, or without sort of more questions being asked. So it's about you and your client working together, and also the client providing you with sort of the correct information as well. So it's also, I think, about knowing your lender's criteria at the moment. I think, we haven't had it easy, have we? We've had COVID. We've then had the mini budget last September. We've then got the EPC changes coming up. I think, we all deserve probably a 3-week holiday all together in Barbados somewhere. We've not had it easy over the sort of last 3 to 4 years. And lenders a lot, and you guys probably use a wide spectrum of lenders. I think we as the lender forget when we change our criteria how many other lenders' criteria use, and you've got to keep up with that. So it's about knowing that lender. My advice would be knowing that lender's criteria when you come to submit that case, so you know that it fits that criteria and it fits that affordability model.
I still have nightmares about that week in September when every lender pulled products within the space of about 3 days. That was interesting. Charlie?
Again, echo what Cara says. I think the biggest bit of advice I'd give on this would be build relationships with lenders. So if you don't know your BDM at certain lenders, get in contact with them. They are going to be your best friend. You're going to be able to send over a fully packaged case with property details, loan size, any documents you've got concerns over, send it across to that BDM and say, I think this would fit with you. Ask them the questions. What have you got concerns about? If you were to come to myself with a case, I'd be able to go to the head of lending with your case, position it to him, and he will be able to give you almost that as much certainty as possible, subject to the full underwrite and the valuation, of course. But that's the biggest bit of advice. Just build relationships, not just obviously keep communicating with your client, but speak to your BDMs, your account managers, the telephone sales team, because at the end of the day, they are there to help you. They're there to assist you. Make sure, because if you submit a case to us and it's in my area, if that case goes through and declines, it is no benefit to myself, you, or the client. I want the case to go through just as much as you do. So send it across to us and hopefully we can get it approved for you.
Brilliant, thank you. I think from some borrowers, there's still a perception that the lender must lend because you put an application in, therefore the lender only going to make money if they lend, so they're going to lend to me anyway. I think certainly over the last 12 months, that's changed a lot more. The deal needs to fit, and it needs, different lenders have got different appetites in different areas for different property types, for different borrower types, and there will probably be a home for that deal. You just need to work that little bit harder to find it, and it's about looking at that whole sector. Now we work with 80 plus lenders that we're completing with regularly. There will be a lender somewhere that will suit what your client's looking to do, and it's just putting that work in to find it. We had a couple of questions come in live, so thank you for these. Keep them coming in. They're certainly testing our brain power this morning, which is great. Question from Suda. Cara, I'll start you off with this one. Why do lenders require the borrowers to be homeowners? More and more young people are living at home and looking to purchase an investment property, but they're very restricted with lenders who can consider them.
Okay, I couldn't comment on other lenders, but at Together, we don't actually require the client to be a homeowner. So we can look at first-time buyers, first-time landlords. We do have sort of some restrictions in the background in respect when it comes to top slicing. So it does depend on what the applicant earns, or we can look at top slicing or not if it doesn't fit on the rental. That's from our stance. I couldn't comment on the respect of other lenders of why they don't, why they require them to be homeowners, because here at Together we don't.
Thank you. Charlie, anything to add to that?
Yes, Cara.
Sorry.
So we don't do first-time buyer, first-time landlord. We do first-time landlord. We just need the client to own and still own a property, whether that's residential or buy-to-let, for 12 months. And I think our almost reasoning behind that is we want to see that they almost have the ability to maintain that payment of owning a property. At the end of the day, it is one of the biggest, if not the biggest, financial commitment anyone ever makes. And if they are a first-time buyer, first-time landlord, that is why we have that restriction in place. We just want them to have that experience. Yeah, sadly, I can't go into too much more detail other than that, but that's what I'd say.
That's good, thank you. There's also the regulatory concern there as well, isn't there? Yeah. If it's harder to prove personal income, you may just be self-employed or have relatively low personal income. It can be easier to get a buy-to-let mortgage by using an AST to prove the rent. So from some lenders that we're talking to, they've got concerns that people might be taking the buy-to-let route because it's easier, whereas their intention might be to live in that property. So there's a couple of different reasons for that, I think, and each lender will have a different reason why they will or won't consider it. But again, from a broker point of view, just think about that plausibility, that if we are doing the deal, does it make sense? Is there a valid reason for it? If there is a reason, there will be lenders that will consider it. But another question come in saying, what support is there for first-time landlords? I think we've touched on this one a little bit previously. We've got a number of lenders out there that will consider first-time landlords, but a lot of it will come back to the broker in order to look at that long-term plausibility. What plans does the client have? Is this a business transaction, or are they doing it just because they'd like the idea of owning a property, and really looking at that solution and making sure we're doing the right thing for them? Anything either of you want to add to that one?
Yeah, no, I think you're absolutely right, Chris. I think you've just got to make sure it's the right application for the right client, and it's the right opportunity for them. And I think what you mentioned before, from sort of the regulatory piece as well, as the cost of living, etc., goes up, people are going to be looking at sort of different opportunities. So you've just got to make sure it's right.
Thank you. And the question that's coming from Rob, a broker can package an application and it can be very strong. However, as the previous broker had mentioned, we're having to stick our finger in the air as the rental valuations from valuers are so hit and miss. What is the risk to the banks in using actual rental income, as it's evident that rents are increasing right across the UK?
So that's something we're currently looking at the moment. We're going through tender with valuers, etc. At the moment, we are looking at bringing on different valuers than we already do have, so expanding our panel, in which case there may be opportunities for us to go off almost, for argument's sake, say it's an MUB or a HMO. Rather than going off a bricks and mortar valuation, we are going to be looking at going off almost a commercial valuation, in which case we are going to see increased valuations on those types of properties. But I think you're absolutely right. I think lenders in general, we do need to almost communicate with you guys prior to even submitting the application. Linking back to what I said about being in contact with your BDM, send it across to them. They may have a contact within their company that can have almost a commercial view on the deal prior to it being submitted. Again, our head of lending's got a very good relationship with one or two people at our valuers. We can, not every time, we can a lot of the time send it over to them and almost get a feel for the case prior to you submitting it. Another thing that lenders have had to bring out is, well, naturally, is free valuation products. Obviously, that way it is mitigating the risk of losing a valuation fee. Of course, that's not something we ever want to happen. It's not just a money-making scheme charging a val fee and then it declining, but there are those options for free valuation. So Perfect example I use is we do a lot of flats above commercial or adjacent. A lot of the time it might be worthwhile sticking that on a free valuation if there are a lot of commercial premises nearby, just because that is going to heavily rely on the valuer's comments.
Thank you. Cara, anything to add?
Yeah, I think for this one, the relationship is key. So as kind of like rents are rising, I think, I was reading an article the other day, and more and more first time buyers are struggling to get on like a housing ladder. So rental is increasing, rents are increasing as well, which may not be reflected in the valuation. I personally have a family member that is currently looking to rent out a property. And there's about 6 people wanting to go for it. Some people have offered them 6 months up front. Some people have offered them kind of double, not double, but a couple of £100 more than what it's actually going for. So I think it's the lenders working with the valuers and their valuations team to look at their increase in rents, to look at the different valuations that we're getting, and to work together then to educate you as brokers of what we can and what we can't accept. And I think as well, it's about speaking to your BDM. So we're here to help you. If you have something that you look at a criteria pack, we're not computer says no company. If you want to pick up the phone, either speak to our telephony team, speak to myself, speak to the BDM at another lender, for example, then we can work with you to help structure that case, that valuation, or that rental in sort of the current climate and in these sort of moving and increasing times.
Thank you. I think just to finish off on that question, there was a point that you mentioned earlier, Cara, around that comparable rent.
Yeah.
So I think what we need to ensure is that because an AST staged rent is, let's say, £1,000 a month, is that the actual market as it stands today, or is that just what one person's prepared to offer on that one property, which, if it comes to be real in 6 months' time, is going to be nowhere near achievable again for the client. So it's just about looking at that plausibility, because ultimately, if we're just using an AST with nothing else to back it up, we're not a million miles away from self-certing that income. So therefore, what else can we use to support that rental income as being a true reflection?
Yeah, no, you're absolutely right. And we've seen it more and more recently of valuers' rents being slightly lower, or even quite a few £100 lower as well than what people are actually, what the AST says. And how we're looking at the moment is, if you can get comparables in that area, and we can look at the comparables and look at the comparables moving forward, then yes, we can get comfortable with using that higher rental.
Had some good success with that recently as well, getting the landlord to go to a local estate agent, get a comparable sheet of properties that they've let in the area, and we have seen lenders use that. However, on the flip side, we have had brokers that just keep sending the same AST back in with a different figure on every time we query the number on there. I know it's a bit higher, now it's a bit higher. It's about that plausibility piece, isn't it, and making sure that the deal we're doing is sustainable, not just to get it completed, because this client might be looking at that property for the next 10 years. How do we make sure that in 6 months' time, when that tenant does decide to buy a property and leave, that client the borrower can maintain that property and keep it moving forward?
I think the other thing is, just to reiterate again what we mentioned earlier, is we are seeing signs of the market improving. The rent going up 12% is an extortionate amount, which, as I said earlier, is bad for the tenant, great for the landlord. The completions are going to start flowing through, in which case, as we reverting back to the question that was asked near the start, once that lag has stopped and those completions come through, we should start seeing an increase in valuations again.
Good point. So sticking with you then, Charlie, where are you currently winning business from some of the more mainstream lenders?
It's criteria driven. I think obviously with mainstream, we're never going to compete on rate, definitely not. But a lot of it is criteria. So Cara mentioned a bit of criteria earlier that I didn't actually know they did as well. But we do corporate lets, which seems to be a very popular thing in the market at the moment because it's almost guaranteed rent. So if you've got a guaranteed rent scheme, subletting it via an estate agency on a guaranteed rent scheme, no issues whatsoever there. Circo agreements seem to be a really common one at the moment. Asylum seekers, housing associations, charities. So that's one almost key selling point of our criteria. Not only limited company, limited companies in general we're very good with, but the structure of the SPV itself. So you could have a holding company or a parent company. As long as that holding company or parent company mirrors the SPV, we are absolutely fine with that. Including that, we're then also absolutely fine with intercompany loans as well as source of deposit. So the holding company could be husband and wife, SPV's husband and wife. That is absolutely fine. It could be family members as well that it isn't quite mirrored. We're again absolutely fine with that. Another bit just to highlight is trading companies. So quite a unique selling point is we're absolutely fine with them. If they own, say, a plumbing business, add on an appropriate SIC code to that business, 68100, we will treat it exactly the same as an SPV. So they're probably the three unusual bits of criteria that we allow that aren't really too common across the market, but three bits that we are seeing a huge, well, not a huge amount of. I think if anyone says they're doing huge amounts at the moment, they're not necessarily telling the truth, but a lot of our business goes down those different avenues.
Thank you. Cara?
Yeah, so I think it together, we're very lucky with the flexibility and what we're famous for at sort of winning applications. And ones that we're kind of sort of key areas at the moment for ourselves where we're winning the business is minimum loan amount. So our minimum loan amount starts from 30,000, so we can look at the low valued securities. We've a lot of declines from other lenders that are coming across our desks are buy-to-let securities that are next to commercial properties. So I had one last week where it was a buy-to-let next to a pub. We won't shy away from those. We can look at them next to pubs, petrol stations, above like fish and chip shops, Chinese takeaways. We're seeing a lot of expats and foreign national investors as well. Whether that we look at a high number of countries across worldwide. And another big one, which Charlie has just touched on, is social housing. That seems to be coming across our desk more and more, whether that be a Serco agreement with the council, a mayor's lease agreement, or whether that's got vulnerable adults from vulnerable children in there. I think it's, as we've touched on sort of previously, it's landlords looking at different opportunities in the buy-to-let area as well.
Thank you. Some nice USPs there that hopefully will help you place some more business. Something that I think you mentioned earlier, Cara, that you don't have a crystal ball. I'm going to ask you to look into it now. What changes do you think are ahead on the horizon?
Oh, very good question. So for me personally, I would love to see the reversal of the taxation rules for landlords. However, I'm no politician. We could all be here all day talking about politics, couldn't we? And I very, very much doubt this will happen. But I think what we sort of anticipate is increases in limited company buy-to-let transactions. The right portfolio landlord will continue to buy. I think as well the EPC requirements will be interesting. I think as we see this unfold, as the time goes on and deadlines can be agreed, well, if they can be agreed, deadlines can be agreed, I think we'll see more and more applications, particularly buy-to-let second charges, as landlords may struggle to improve their property. And I think as well, tenant demand will still be high. I think we touched on it earlier, and it was in the news the other week, is first-time buyers are struggling more and more due to the current climate to buy their first property. So as over the next 6 to 12 months, I think we'll see more demand for the first-time buyers to actually rent. Nobody wants to be at home with a mum and dad forever, do they?
Thank you. Charlie, how about yourself? What can you see in your crystal ball?
Well, there is a housing shortage, we know that. So I think naturally the buy-to-let market is going to still be needed. It's still going to be buoyant. There's still going to be opportunities for, again, mentioned earlier, portfolio landlords to seek opportunities. If a casual landlord is naturally selling off the 1, 2, 3 properties that they own, that could create an opportunity for a landlord to expand their portfolio. I think one of the biggest things that we're going to still see, which we're not seeing at the moment because we don't do it, but I will let everyone know, is speak to your accountant and get them to speak to their landlords about the right tax advice for incorporating their portfolio from the personal name into a limited company. Using Section 162, the tax relief, they're coming out of the benefit period. It's a huge opportunity for you guys to write a lot of business. And secondly, the huge benefit for the landlord in transitioning it from the personal name into an SPV. That's where I think a lot of the market's going to go to. I think it is going to be a lot of limited companies, but also the other opportunities to maybe earn a bit more money for a landlord is to expand it and start diversifying by looking at HMOs, MUBs, holiday lets. Holiday lets, because the return is so much stronger than a standard buy-to-let. We do holiday lets. Cara, you do holiday lets as well. So there's loads of lenders out there who can assist you with those cases. Biggest thing to look for is just how a lender values a holiday let. So some lenders will do it off low, medium, and high seasonality. Other lenders will look at it via a standard AST. So that's just something to look at. But I think there's huge opportunity for everyone. Just keep speaking to your landlords, speak to accountants, speak to surveyors. And if anyone needs anything after this, by all means, please get in touch.
Yeah, thank you. We do have another series of webinars that would be highly interesting for you to tune into around that taxation advice, where Dan Morris does sit down with an accountant and talk through some of the opportunities open. So have a look at your emails. There's invites going out regularly for those. That might shed some more, put some more meat on the bones of what Charlie's talking about there. If you take a look at the chat that's come through, you'll see that we've put the download document there. So there's a Buy-to-Let 101 guide, just with some key hints and tips for you to download that hopefully will, again, just add some more meat to what we've been talking about today. You've kindly answered my questions through the course of the morning. It would be unfair if I didn't give you a chance to pitch yourselves. So Charlie, as we finish with you on that one, a quick pitch from you to our brokers about TML's lending.
So predominantly just staying on to buy-to-let. Obviously, we are known to be an adverse specialist residential lender. Buy-to-let, we are anything quirky, ranging from your limited company to trading company to corporate lets, and everything in between, from HMOs up to 6 beds, MUBs up to 6 beds. Some of the easier bits of criteria with us is how we underwrite a buy-to-let case. So we don't ask for bank statements. If you're a limited company or you're a high rate taxpayer, we do not ask for income docs. The whole point of our buy-to-let process is to try and get it through as quick as possible for you. So realistically, if it's a buy-to-let remo, all we are needing is a direct debit mandate, a customer declaration form. We are then going to run an AVM when that launches in about a month and a half. Realistically, we don't need anything else. It should be that simple to get a buy-to-let remortgage through with us once we launch AVMs. So anything quirky that you have got, please get in touch with us. If you go on the website and you type in your postcode, it'll pop up with who your relevant BDM is. And as I've mentioned 2 or 3 times throughout the meeting, get to know them, set up a meeting with them. They can go through all our criteria in more detail with you. And as I say, they'll be able to give you those hints and tips as well on how to write more business, etc. And hopefully we can help you out with some of that.
Thank you. Cara, your turn.
Yeah, perfect. Thank you, Chris. So here at Together, we pride ourselves in flexibility in our common sense lending approach. We're not a computer says no company. We manually underwrite all our cases and we want to work with you. We look at buy-to-let limited company applications, individual applications, first-time buyers, first-time landlords, as I mentioned earlier, expats, foreign nationals, etc. We look at different types of property types and your non-standard construction properties, your buy-to-lets next to your commercial securities. And we want to work with you. We want to help you and help your clients. We mentioned earlier about decline. Declines are frustrating for everybody. We want to get your application from application to completion as quick as possible with the most streamlined approach. And like Charlie mentioned, we also have local BDMs across the country. You can find those on our websites. You can also find our most up-to-date criteria on togethermoney.com. along with our most up-to-date sort of packaging guides. If you do need anything or you do have any questions, please feel free to reach out at the end, or pop to our website to find your local BDM at We Want to Help You.
Thank you. And at Crystal, we've been in business now for coming up to 45 years. We specialize in specialist lending. So if you've got any questions at all about anything we've talked about today, or any cases that land on your desk that we need some help with, please let us know. We've got a mortgage desk where the guys are waiting to take your call. You can give us a call now, 01827 33 7710, and we're more than happy to talk through any scenarios that you have there. That brings us to the end of today's session. Charlie, Cara, thank you so much for your time and for your expertise today.
No, thank you.
Attendees,
Thank you.
thank you. Attendees, I hope you found that useful, and hopefully now you've answered some of your questions, you feel more confident to assist with your clients' buy-to-let needs. The market is still strong. There are still opportunities there. It's probably fair to say we just have to dig a little bit deeper to find them than we did maybe 2 years ago. But for the good brokers looking to help the good clients, there's certainly a lot of business that we should be doing and we should be writing together. So please give us a call if you've got anything we can help you with. Keep an eye on your emails for the details of our next session. All that's left for me to say is thank you for joining me. Stay busy, stay safe, and see you again soon.